All right, good afternoon, everyone. We're going to begin shortly. Today's session is on stochastic trading strategies. This is going to wait 1 or 2 more minutes for people to come in. For today's session, if you have any questions along the way, feel free to put your questions under the chat or the Q&A section. And as we go along, I'll take a look at the 2 segments and ensure that we have all of the questions answered. Okay, maybe I'll just do a quick introduction about myself first before we start the session. So my name is Sherman, and I'm the R&D lead for Zeta Labs. This is a webinar collaboration between Zeta Labs and Vantage. So Vantage is the broker. And today's session will be on stochastic trading strategies. Okay, so before we begin, I just want to put up this disclaimer that anything that we're going to discuss today or go through today is something that is subjective. So do ensure that anything that you take from this session is in line with your own trading objectives. Trading derivatives is risky, and so do ensure that you, if you need any guidance or advice, do seek independent advice if necessary. Otherwise, we'll begin this session. So today's agenda is on trading stochastics, trading strategies using stochastics. So stochastics is basically a very basic tool that most traders use to identify certain regions of overbought and oversold in the forex market, actually in any sort of market. We're going to talk about how the standard stochastic strategy, and then we're going to look into some form of stochastic divergence concepts. And then last but not least, we're going to use some examples and identify certain trading opportunities using the stochastic trading strategy. Okay. So for those of you who are not familiar with stochastic trading strategy, I'm just going to go through the basic overview of what it, how it works, and then I will talk a little bit more on how you can use it in a more intermediate, advanced level of trading. Okay, so basically, it's an oscillator, and an oscillator is basically a tool for us to actually look at how the market is moving. So for stochastic, it ranges between the 0 value as well as the 100 value. So in a particular market, right, there are 3 types of market. One is basically the bullish market, which where prices moves up. There's a range market and a bearish market in which the market moves down. So in most cases, in a ranging market, you'll see that prices are in line with the stochastic oscillator. So what it does is that because the prices do not go in one direction only, it usually goes up. So for example, in a bullish market, it moves up, and then there's some sort of retracement before it moves up again. So it oscillates between a mean. In a bullish market, this mean will be upwards in an upwards direction. In a bearish market, the mean will be in a downward direction. Okay, but in a ranging market, you see that the stochastics values, or the stochastic values that are calculated by default, will actually be the same as the price action you see on your chart. Okay, so anything above 80, given a specific period, stochastics has a look back period, and by default, most people use 10. It's actually dependent on the time frame they're looking at. Most people on an hourly time frame, you look at a 10 hours look back. For a 4 hours time frame, you might be looking at a 3 days look back. And then if it's on a daily, you'll usually look at a 5 days look back. Okay. So as it approaches above 80, the most direct indicator for it above 80 is that it's in an overbought region. It means that people are buying. There's aggressive buying. There is a lot of bullish pressure, and the first thing that comes to mind is that in an overbought region, right, prices tend to reverse and a sell-off will begin. Okay. Similarly, when prices move towards below 20, right, from 0 to 20, that's the oversold region, and usually indicates a lot of selling in the market and a reversal is about to happen. One thing to take note of is that it doesn't mean that you should always sell in the overbought region and buy in the oversold region, right? It's just an indicator to tell you that given that look back period, we are now in the same position or the same price level that we were at the 14 period prior to this current period, and that it can actually remain in this overbought region for extended periods of time if there is a lot of bullish pressure in the market. Okay, so do take note that selling at overbought regions and buying at oversold regions, right, will only work very well in ranging markets. Okay, if there's a trending market, then that's where it will not work as effectively as the ranging market. Okay. So using the stochastic, you can see that when there is a bullish market, a bearish market, or ranging market, you see that your stochastics shows the same thing, right? So it works the best again in a ranging market, and during a bullish market, you tend not to have a lot of signals from the oversold region because there is a lot of bullish pressure in the market. You will not get a lot of oversold signals, and in a bearish market, you will not get a lot of overbought signals. So once you understand this, you'll realize that the 80-20 default thresholds are sort of like a benchmark. But if you have already identified a bullish market, you might want to use a lower, a higher oversold region. So instead of 20, you might want to shift it up to 30 or 35. And in a bearish market, you might want to lower the threshold for the overbought region and sell at say 70 or 65. Okay, so you have to understand that in a bullish market, prices, the signal for the stochastic indicator tend not to go into the oversold region, and in a bearish market, the stochastic indicator tend not to go into the overbought region. And of course, once you have this big moves, this big spikes, and the market enters a ranging market, you can actually just follow the stochastic indicator and sell at overbought regions and buy at oversold regions during a ranging market. Okay, again, some of this might be a bit confusing for you guys. If you have any questions, feel free to put it in the webinar's chat, and from time to time I'll take a look at it and we'll go through those questions. Okay, again, this reiteration of the stochastic. Again, by default, your upper bound is the overbought region, which is at 80. The lower bound is 20, which is the oversold region, right? The best time to actually trade this this region is during the ranging markets, which usually happens after a big move in prices. So once there's a big dip or a big spike, then it enters a range, and during that accumulation or distribution phase, that's the best way to actually sell at overbought regions and buy at oversold regions. So when you look at this stochastic indicator here, this itself is a range, right? So this itself is a range. So your stochastic will only work will always work till it doesn't work. So what I mean by that is that if you were to sell at this level, which is around here, you have made money. Again, at this level you buy, right? You have made money, right, to this level, and then you have sold here, and you probably like think this is going to happen again. But we have to look at the range that it is in, and once it breaks out of that range, there is going to be a new range here, and then another range here. So you have gotten this trade, and then gotten out of this, but this buy would have failed because it broken out of this current range, and the stochastics will work for this range until it breaks out. So it works till it doesn't work, right? So it will break out to this level, and again, this is the extended period I was talking about just now, that the price or the stochastic value will remain in the oversold region for a prolonged period of time during a bearish market. And then once it enters a range, then you can apply the same thing again, sell at all the overbought regions, and then buy at all the oversold regions. And you would have sold here, right? Bought here, and then sold here, and then buy here. I'll go through one way in which you can identify what is a valid range and what is a bearish or bullish market. So in a sense, when it's a bearish or bullish market, it will not work as well as when it's in a range. Okay, so essentially, if you look at the most basic form of what the stochastics is trying to tell us, is basically trying to measure momentum. And not only the stochastic oscillator, you can look at the relative strength index, the RSI. A lot of these indicators, what they're trying to do is they are using the price data, the open, high, low, close of each candle in each particular time frame, and basically it's calculating the momentum, how fast you're moving at this current period of time versus a period, say 14 days ago, 14 hours ago, in the last London session, in the last New York session, so on and so forth. So what it measures is the momentum, and if the momentum is faster at this point in time, then you expect, again, momentum is the rate of change of prices, right? If it's moving faster than it was 14 hours ago, we can follow in that direction of that trade. Okay, so if prices, if we were to go back again, right, what it is measuring here versus say 14 candles ago, right, is just telling us that at this point in time we are super bearish, right? And as it continues, right, and breaks below this range, we know that momentum towards the downside has increased, and we should be following this direction. Of course, we could have taken this buy, but with a stop loss, we could have been out of this position and then continue down towards by following the direction of the trend. Okay, so this oscillator is good for ranging markets. For trending market strategies, might be you might want to consider, say, MACD or the moving average strategy, which we will not be covering today. Okay, again, stochastics, we're measuring the momentum. Momentum is the rate of change. So we are just comparing the current value against the price X periods ago, X being, say, 5 hours, 8 hours, 2 trading sessions ago, depending on how frequent you want to enter your trades. So for example, if you are going to enter 1 trade a day, it makes sense that you're trading on the 1 hour time frame, right, before end, and 8 hours look back, due to the fact that 8 hours is around the period of each trading session. And if you're going to trade once a week, it makes sense that you're trading on the 4 hours, or at least at the daily level. And if you're a scalper, if you're a day trader, or if you're sort of like scalper in general, then you might be looking at 5 minutes, 15 minutes, and looking at what happened 1 or 2 hours ago. So it really depends on the preference of the trader, what kind of trader you are, and identifying which level, which time frame you are trading. And then with stochastics, with the stochastic, there are actually two lines. One is the stochastics level, the signal, and the other one is the SMA of the stochastics. And basically that is the average of the average. And what it does is basically to allow us to get a signal whenever there is a crossover between these two lines. Okay. So this is a little bit, this is the next part of stochastics, basically looking at stochastic divergence concepts. So we know that stochastics measures the momentum of price action, but what happens when it diverges from the price action itself, and what can we actually tell from that? Okay, so an example here is that for price itself, right, we look at two lows that will form inside the oversold region, right? What we're looking at here is that when prices made this low, right, it was in the oversold region, and then when it made this low again, it was in the oversold region as well. But what we can see here is that was this price caused by sufficient volume or the lack of volume from the opposite side of the market? And as prices form a lower low, this price action here, as it forms a lower low, while the stochastics form a higher high, we call this a divergence. And this is not a deterministic signal, but what we can infer from this point in time is that this downward movement is stronger than this downwards movement. Okay, and if you are sort of seasoned in looking at price action, you'll understand why this downward movement is stronger than this downwards movement. Okay, for those who are not familiar with how this signal is formed, this downwards movement was caused by this upwards movement. So if you can see the magnitude is basically the number of pips that was created from this upward move versus the number of pips from this downwards move. We can see that this downwards move is roughly around 2.5 times the size of the upwards move, right? And even though this downwards move is much bigger than this downwards move, we're only comparing it against say a 14 period look back. So we're actually comparing this downwards move versus this upwards move. So when we compare this upwards move against this downwards move, it's probably about 1.3 times the size of this upwards move. So when we compare this versus this and this versus this, we can conclude, but just by looking at the price action, that this downward movement is much more aggressive than this downwards movement. Okay, again, this is something that you can infer from the price action, but if you want to infer it from the stochastic values, it's much easier because as long as there's a divergence, you know that this downwards move is weaker than the previous downwards move. And what happens when we have this divergence? Okay, so as price moves downwards and stochastics is upwards, we call this a bullish divergence, and it's the same for the for the opposite, in which price moves up and your divergence, your stochastic value goes down. That would give us a bearish divergence. Let me see if I can find a okay, I can show you guys the opposite. So what is a bearish divergence? It would be something like that. So this form a higher high, right? Prices. This move up versus this move up. We're just comparing these two move up. And what we're looking for is that this should enter into a higher overbought level, but instead it forms somewhat of an equal or lower overbought stochastic signal. And as prices moves up, we know that this is a weaker move as compared to the previous move upwards. So this forms a bearish divergence. So this is a bearish divergence, and then this is a bullish divergence. Okay. So I'm going to go through some examples, and then if you guys have any questions, you can go through them. Okay, so let's identify the period look back, tuning the look back period. So even though the default can be, say, 1033, 533, we have to ensure that we are tuning it based on the preference of the trader. Okay, so again, if you're trading on a daily time frame, when you're trading on a daily time frame, it means that you want to enter at most one trade a day, or one trade every 3 days or a week. Okay. This again is not a hard and fast rule. It depends on the trader again. But I would choose a 12-day period. A 12-day period looks at basically a 12-day period will be roughly around 2.5 weeks of data. And during these 2 weeks of data, as we know, every single week there are major news, there are minor news, and basically this takes into account what happened in the previous 2 weeks and where you are currently. And that will actually allow us to compare what was the price action 2 weeks ago versus the current week. So we are actually comparing the average rate of change for half a week if we are using a 3-day SMA. Okay, in a particular week on a daily time frame, there will be 5 candles. So using a 3-day SMA, we are basically looking at the average rate of change. The stochastic value is the rate of change. The second signal line, which is the orange line, would be the average rate of change. And by doing that, we can actually get a signal comparing what happened within the last 2 weeks versus what happened in the previous half of this week. Okay, on a low time frame, if you're looking at 5 minutes time frame, 5 minutes time frame, you can actually trade once every trading session. So once in the Asian session, at least. Okay, so you can do more than one, but at least once in the Asian session, once in the in the London session, and then once in the New York session. Okay, trading on the 5 minutes time frame, I usually look at a 4 hours look back. A 4 hours look back is basically half of each trading session, right? So you basically, if you're trading in the middle of London session, you're taking the end of Asian session and start of London session. If you're trading during the New York session, you're looking at the later half of the London session. Okay, and then a 1 hour SMA. 1 hour SMA gives you 12 candles, right? So that's basically the average of what happened in the last 1 hour, and whether or not that signal will give you a good signal based on what happened in the last 48 hours. Okay, so it depends on the preference of the trader again, whether or not how frequent you want to trade. And if you're trading very frequently, you probably want to do it on 5 minutes time frame. And if not, I would say the recommended one would be 4 hours and on the daily time frame. Okay. So a few things to note. Firstly, we need to identify the trend of the symbol that we are trading. So one a quick way to actually identify what the trend is basically using a. So just look at the trend. I'm just going to go. It's not written here, but let me just go through one of the ways in which you can identify a clear trend. Okay. So you know that the oscillator, the stochastic oscillator, right? This indicator here basically oscillates or it just cycles around an overbought and oversold region. So in a ranging market, you'll see that price moves in this manner as well. And this is basically a sine curve, right? And the mean is basically it just cuts through the sine curve. Okay. So when you're in a ranging market, right, you see that your sine curve, your price action sine curve will be the same as your stochastic sine curve. Okay, so in overbought regions, when it enters overbought regions, your price will be above the, okay, this is not drawn accurately. Let me just draw it accurately. So it will be something like that. Okay, in a ranging market, right? How do you identify if it's a ranging market? When it's overbought, your price is above your, say, a given SMA. I'll use like say 21 period SMA, and when it goes below, when it's in the oversold region, it's usually below the SMA. Okay, what happens if it's in a bullish market? In a bullish market, how you identify a bullish market is that prices will be something like that, all right? And you have your sort of your SMA cutting through the sine curve, and this sine curve has a positive coefficient, which means that it is actually moving upwards. Each high is forming a higher high, right? And your stochastic values, when it's roughly in the oversold region, it is let me just erase this. Okay, let me draw it again. So in an upwards moving, if you have a 21 period SMA, okay, more accurately it will be something like that. Okay, and then when it reverses, it goes down, and then it goes down again. Okay, so it means that price is moving faster than your 21 period average, and your oversold regions will tend to be above the 21 period SMA. Okay, and same thing for the in a bearish market, right? Your bearish market would look something like that, and your average will be something like this, and all of your overbought regions will tend to be below your moving average. Okay, if they are not below your moving average, it means that that downward movement is weak, and you can apply the basic strategy for stochastics, because if it's a weak trending market, it usually means it is it's a pseudo ranging market, and you can trade the characteristics of the stochastic strategy. Okay, so another key thing to note, let's continue from here, right? Always good to identify the trend first, right? And then in an uptrend, buy when stochastics is oversold. Again, I mentioned earlier, in an uptrend, stochastic value will most of the time tend not to go below 20, right? So if it's in a bullish market, in an upwards market, you will need to readjust that oversold region from 20 and probably increase it up to 35, right? Or any value that you deem appropriate, but prices will tend not to go below 20 during a bullish market. And in a downward trend, right? Prices in a downward trend, your stochastic value will tend not to go above 80, so you need to reduce it to say 70 or 65. Okay. Again, this value means nothing to a manual trader. If you are coding out your strategy, if you're using some sort of script or algo trading, this will make more sense. Once you have identified the trend, your threshold will change accordingly to the trend that you are in. Okay. Again, yeah, so strong bullish bearish trend. So in this trend, just by eyeballing it, you don't need to quantify that this is in fact a downtrend, right? The chances of prices entering into the overbought region, right, is very rare. Okay, so in a very basic, straightforward strategy, right, most algo traders or manual traders, they will tend to get a lot of signals to buy in a downward trend. Okay, so they tend to buy here, they tend to buy, say, somewhere around here, then here again. And so if you were to buy in all of these areas, yes, you'll make say this amount of pips, this amount of pips, this amount of pips, this amount of pips, right? But again, if you were to identify the trend and lower the threshold at 75, you would have entered the bigger move, which is the downward move. And of course, you can have all of this, but and that's what most algo traders will enter, because it's easier to get oversold signals as compared to overbought signals. Okay, so you have to take note of that. If you're a little more advanced, you will find certain ways to omit the buying in a downward trend. Okay, and basically, same thing as what I mentioned earlier. Your SMA would look something like that, right? And all of your because all of your overbought regions will be below your EMAs or your SMAs, you'll basically prevent any buying from happening during this period. Okay, there might be a buy somewhere around here. So this is a ranging market, right? So you sell here, buy here, sell here, and you would have bought here. Okay, and when you buy here, basically you get stopped out. But once there's only one stopped out. But once you go into this trend and you prevent any more buys, yes, you lose this, but basically you gain all of the sells from here. Okay. Again, there are many ways to identify areas, the trend, and then many ways to identify when should you not buy and when you should not sell. But basically, this is how you can use the stochastics for your trading. Okay, so again, this is basically a case study using USDCAD, a 4 hours period versus a 15 minutes period, right? So in a 4 hours period, right, using these parameters, 48, 3, 12, right, you probably have 2 entries. But on the 15 minutes time frame, you will have 3 entries within that same month. Okay, again, the SMA is probably something like that, right? So once we break above this level, we only consider buys, and we have considered buys here, considered buys here, and considered buys here. And if you were to shift your threshold above to say 35 or 40, you have more entries coming in to this big move up. Yep, same thing. If you're using 48, 3, 12 on a 15 minutes versus a 16, 3, 12, again, this is very dynamic. The loopback period is very dynamic. A 48 lookback on a 15 minutes time frame is a 12 hours lookback, right? You get 3 entries, and then a 16 on a 15 minutes is a 4 hours lookback. Okay, a 12 hours lookback is half a day, 4 hours is half a session, and you basically get 1 additional entry just by readjusting your lookback period. So all of this tuning is really dependent on the preference of the trader. You have to ensure that this is something that you're comfortable with. Are you going to sit at the computer for 12 hours to trade once every 12 hours? Or do you want to have at least 1 trade every 4 hours? So depending on how much time you have as a manual trader, of course, if you are an algo trader, then basically you can run both. The algo will run 24/5, right? But if you're a manual trader, you have to decide how often do you want to enter the trade, right? And this, the lookback period will determine that. Okay. So in summary, I think stochastic is pretty straightforward. It's kind of like one of the oldest or one of the most used indicator out there. I think a lot of people would argue that, you know, like oh, it's outdated, it's not really accurate, but it really depends on how you're using it. And I think a lot of people do not actually know what it actually means and how you actually derive the values. But once you understand and understand how the calculation is done, you probably can get a better understanding of how to use the stochastic. Okay, so again, the most basic ones, there is an upper and lower bound, which can also be defined as the overbought and oversold region. The next step to stochastic is to be able to identify bullish and bearish divergence signals. Again, this is a sort of like a advanced step when you consider stochastics. But the other way to find divergence is your MACD. MACD is using the moving average convergence divergence. So it is looking at the how different moving averages converge. Converge is when it forms this thing, right? When it converges into a single point, and how it diverges out due to the difference in the loopback period. You can use the MACD as a more straightforward indicator as compared to eyeballing price points and divergence. They actually tell the same thing, and the signals might be 1 or 2 candles apart, but the accuracy will be probably around the same percentage. Okay, again, many people use stochastics in all market conditions, but you need to be aware that stochastic works the best in sideways or ranging markets. When it's up and it's a bullish or bearish market, you have to first identify it and then change your threshold levels such that your stochastic works for you, right? Some people in an uptrend, they are still using a oversold region of 20 and they don't get a lot of signals. They get more overbought signals in an uptrend, and they're like wondering why they're selling in an uptrend, right? And vice versa, the same thing as well. And so if you do not identify the trend, you get a lot of opposite signals. And then when they try to reverse the signals and it goes into a sideways market, then that's where they realize, oh, stochastics doesn't work. But in actual fact, they miss out this step before they execute the strategy. Okay, in an uptrend, this is another method for us to get more accurate signals, right? Define key support zones. Buy when stochastics is oversold and in those regions, and then vice versa. In a downtrend, define your resistance zone, and then sell when stochastics is overbought. Okay, and the key thing, very important, tune the lookback period to the market open cycles, so that you're not looking at outdated data. You're looking at the most recent data to identify certain key areas. Okay, so with that, I think that is about it. If you guys have any questions, I'm open to answer them. We are slightly overrun, but maybe I can give you guys a live example of stochastics, and then see if it makes sense from what I've just mentioned. Okay, so here I have USDCAD on the 5 minutes. I'm just going to go through this very briefly. Please do not take this as a signal to enter a trade. Okay, so basically USDCAD is in an uptrend, but what we can identify here is basically the range that we are in. Okay, so this is a range that we're in. So in most cases, right, you sell here. Basically, if you look at your stochastics, this is your oversold. So most people will sell here and then buy here, sell here and buy here. And again, the first step to stochastics, as what I mentioned just now, is to identify trend. And you don't really need a lot of indicators to know what kind of trend this is. This is basically an uptrend. Again, this is very subjective. Some people might say this is might beg to differ that, you know, this is a downtrend or uptrend, but it really depends on the trader. But to me, this is an uptrend, right? And currently we are in this box, right, on the 5 minutes. So what happens is the trading plan would be that at this point in time, we want to find out, because of this last support region, we want to buy at this level, right? But right now, it's still not in the oversold region. And in fact, prices have broken below this last low. And so what I'll expect is that it will move down, right, to enter a new range. And once this happens, right, as it comes back up, it will form this new box, right? Say, for example, this is the new box. And what I will be watching for is that prices for the stochastic, the indicator, would go into the overbought region when it enters this level. And then that's where I will start to sell and then follow the trend down. And then as it goes up again into the overbought region, so on and so forth. Okay. Of course, what might happen is you might just go up here, and then once it breaks out of this level, again, we can use a reference from the back. Okay. So we can identify this as a range, right? So why identify this? To identify a range, you just need 3 points. Just 2 points to define that range, and then a retest of the low range. And as it comes up, this will form a valid range. Okay, again, in an uptrend, we're looking at say 35 or 40, right? It comes in here, it breaks above this level, and as it comes down, this will be my new range. So I'm just looking for buys in this range. If we zoom in a little bit, right? This is 1 point, 2 point, came back to retest this third point, and now I know this is a range, right? So 1, 2, 3, and I'm looking to buy when it comes back down to this level, and then this is the range that I'll pick. Okay, so I think it's kind of pretty straightforward. You just need to identify the trend, then the range. Again, in every trend, there's a range, and in every range, there's a trend. So it's not fixed, right? So if you're able to get that point there, then you'll be able to trade the stochastics easily. So again, gold, pretty straightforward as well. So again, define the trend first. Your trend is a sort of so again, how often do you want to trade, right? If you are going to trade once a day, or are you going to trade once a week or every trading session? We know this was an uptrend, okay? Right, this was an uptrend, it came down. There's a break of level here. So right now I'm looking for actually there is this move down based on news, but it held this level. So on the 4 hours, right, what you can actually identify here is this range here, right? So stochastic on the 4 hours based on a 14 period look back, and of course we can rearrange this to be slightly more relevant to us. So if I do 10, right, it wouldn't differ a lot. So some people might argue, oh, why not use 11? Why not use 12? It doesn't matter. It's roughly going to be the same, right? So you see the 14 period and the 10 period is roughly the same. And what happens was that this was the oversold period. It came back down to this level, and then, in fact, this was a greater downward movement as compared to this. Eyeballing it, we can tell, but if you use the stochastic values, you can tell it. You can see it as well because it formed a lower low, while price action actually formed the same high. So in fact, this is a what we call price moving higher, right? Slightly higher, but this goes down. You know, like if you go back to the slides again, this is a bullish divergence. Okay, so again, what we're looking for at this 5 minutes, right? If we were to sort of use the range method again, 4 hours, we're looking at uptrend. So now it has broken up into this, right? So it's going to form a new range here. Okay, so I do not know how high it's going to go, right? I cannot determine that level. I'm just going to let the market, but it's immaterial. I do not know. I do not need to know how high it goes, right? So let's say it goes up to this level. What I'm interested in is that as long as it moves up and as it comes back down, this level maintains, right? It can go down a little bit and it moves up again. At this point in time, if it's somewhere in the oversold region, right, I would start to buy, and then it probably does something like that, and then we have to see where it breaks out again. Okay, so breakout, retest, buy when it's around the oversold region, and then we continue in this range. So it's not important to know where the price is right now, where the price will end up, right? But if you do enter a trade, right, based on the stochastic values, if it comes back down, right, and you enter a buy here, right, this level will give you your first TP, right? And then if it ranges again, then you might get out of your position or move to break even. Okay, so that's kind of like the idea for stochastics. It's pretty straightforward. Once you understand how it works, first you define a trend, then go into a lower time frame, find that range, wait for the breakout, and then retest onto the previous range highs for a buy, and then the previous range low for a sell, and then you re-enter on the retest, and then basically trade within that range. The key thing for stochastics, again, is to always trade your stochastics within that range. It works the best in a range. Buy at oversold, sell at overbought. Sell at overbought, buy at oversold. Right, okay. And again, this range here again, right? It might be super underwhelming. It might just be this range, right? So depending on whether or not you want to take it's really up to you, right? As a trader, do you want to take this range? Do you want to risk this number of pips for a certain stop loss? And this has all of the points of an upward move, right? From a higher high, there's liquidity here. So in fact, if you use the stochastics, this will work in the range, but once it breaks down, then you'll need to find that new range and trade your stochastics. Okay, so I think overall that's about it for stochastics. If you guys have any questions, feel free to drop us an email. You can find all of these webinars at this website here, vantagemarkets.com/webinars. Again, this webinar is brought to you by Zeta Labs and Vantage. We hope to see you again in the next session. And then that's about it for today. Thank you guys for coming, and then have a great day ahead.